Guys, let's revise IND AS 7 cash flow statement or statement of cash flows with the help of our chart book. So this is something which you've been experts, you've done it in 11th grade, 12th grade probably, and your CA intermediate also. Cash flow statement was a big ticket topic there. Yeah. And CA final also we have spent some time on this. Yeah, okay. So yeah, let's run this by now. So cash flow statement is simply a statement which captures cash coming in and cash going out. Though the statement says cash, here this particular statement captures cash and cash equivalents coming in, cash and cash equivalents going out of the organization. So basically inflows and outflows is what we are trying to track in this particular standard. Okay, and this inflows and outflows we put it under three buckets or three categories. Those categories are cash flow from operating activity, cash flow from investing activity, cash flow from financing activities. That's all. All right. So now if you just have to give, what are the common examples of cash flows relating to operating activities? Cash sales, cash received from debtors, cash purchase, cash paid to creditors, employee expense paid, rent, electricity, salary, all these operating expense paid. All these are examples of cash flow from operating activities. So what are the examples of investing activities? Investing activities means first thing, where and all can you invest within the organization? Purchase of asset, right? So PPE purchased, intangible asset purchased, PPE sold, intangible asset sold. All these are investing activity. Or investment made, investment purchased, investment sold. If you purchase equity shares as an investment, you might receive dividend. If you have invested in some other company ka bond, or if you have invested in some bank deposit, you will get interest. So dividend received, interest received also is an example of investing activity. Okay. Next is financing activity. How and all can a company raise its finance? One by issuing equity shares, one by issuing preference shares, one by issuing debentures. So issue of all these instruments are financing activity. So if you issue of these instruments are financing activity, the redemption of these instruments, buyback of equity shares, redemption of preference shares, redemption of debentures, all these are also financing activities. On equity shares and all, you have to give dividend. So dividend paid also is an example of financing activity. On debentures and other loans, you will pay interest. So interest paid is also a financing activity. So these are some of the common examples of financing activities. So what about tax paid? Tax depends. If they don't give any information, tax usually will be paid, or the maximum portion of the tax we assume that it is paid towards operation. Hence, tax paid we showed under operating activity itself. However, if more information is given about tax, it could come under investing and financing activity also. Like if you are paid any long-term capital gain tax. Long-term capital gain you will pay when you sell an asset. So sale of asset is an investing activity. So in that case, tax paid will come under investing activity. Suppose you are paid dividend distribution tax. Dividend paid is a financing activity. So dividend distribution tax on that also will be part of financing activity. Though DDT now is abolished, but just saying. So tax could come anywhere. If they don't give information, we show it under operating activities. That is one. All right. Now, cash and cash equivalents. So cash for this purpose means cash in hand as well as cash at bank. So what does cash equivalent mean? Name itself is saying cash equivalent. They're not cash, but they're equivalent to cash, like short-term investments. If you have any short-term investments with a maturity period of less than 3 months, with the total holding period itself, you buy an investment with an intention to sell it off within 3 months, not to hold it beyond 3 months. Okay, and it has insignificant value change risk, and it is readily convertible into known amounts of cash. If you have short-term investments whose value doesn't fluctuate much, okay, that you can consider it as a cash equivalent, like investment made in government bonds or treasury bills, etc., etc. So investment in equity shares, no. One of the criteria for cash equivalent is the value change risk should not be significant, meaning its value should not fluctuate much. When it comes to equity shares, cryptocurrency and all, no, the value changes a lot. It could increase and decrease significantly. So value change risk is significant. So we don't consider investment in equity shares generally as a cash and cash equivalent. Okay, that's one. All right. Yeah. And bank overdraft also we show it as a cash equivalent itself. So if you have any bank overdraft, it doesn't come under any other category, and a cash equivalent only you will show. But bank overdraft is a liability. No? Yeah. This liability is deducted from the cash. You have cash in hand and cash in bank. Take that, and if you have any bank overdraft, reduce it and show that the final number in your cash flow statement. That is one. Next, this cash flow from operating activities. To find out cash flow from operating activities, we have two methods. One is a direct method, another one is the indirect method. Direct method means like all this cash received from debtors, cash sale, cash paid to creditor, all these information will be directly given to you in the problem, or they'll give you some information using which you can find out these information. If that is the case, we'll go for direct method. Or if those information are missing, then the more popular method of finding out operating cash flow is indirect method. Under indirect method, we use profit as a base. Use P&L as a base to get operating cash flow. Okay. Usually we take profit before tax. Sometimes if they may give you profit after tax also. If they give you profit after tax, provision for tax, you add back. Okay. So basically profit as a base is used to find out operating cash flow. Okay. So now the problem with this method is we are using profit and we're taking profit as a starting point and try to arrive at operating cash flow. But profit, no sir, or P&L will include all types of expense. Like it will include non-cash expenditure also. You will have depreciation, amortization and all. That is a non-cash expense, right? Now under this method, the drawback is you're using profit. If like here, if profit is 1 lakh means indirectly you're trying to say operating cash flow is also 1 lakh. Because from profit only you're trying to get operating cash flow. But straight away profit you cannot take as operating cash flow because profit will have some non-operating items, non-cash expense, non-cash income or non-operating incomes, etc. etc. So you'll have to do some adjustments. The first kind of adjustment which you usually do is if you have any non-cash expenditure like depreciation, amortization, due to this non-cash expense, P&L balance would have reduced. Since P&L balance has reduced and under this method from P&L only we are trying to get operating cash flow. So due to this expense, P&L balance is reduced means indirectly your operating cash flow also has reduced. But cash did not go because it's a non-cash item. Hence to restore the balance, we add back. So if you have any non-cash expenditures like depreciation, amortization, we add back. Similarly, if you have any non-operating expense like interest paid. So if when you pay the interest is an expense, right? So due to this, P&L balance would have reduced. But interest paid is a financing activity. But it has reduced your P&L means it would have indirectly reduced your operating cash flow also because under this method from P&L only we are getting operating cash flow. So if your P&L has reduced due to interest means your operating cash flow has also reduced. But this is not an operating activity but a financing activity. Hence we add back like that. Similarly, if you have any non-operating incomes that we reduce. Why? Sir, non-operating income could be your interest received or dividend received. If you receive some interest or dividend, your P&L balance will increase. If your P&L balance is increased means your operating cash flow balance also has indirectly increased. Yes. But interest received, dividend received is not an operating activity, but they are investing activity. So, but your operating cash flow has increased. Hence to restore the balance, we reduce it like that. And we also need to give effect to working capital changes. Working capital changes means the current assets and current liability. I've told you the logic of each of this. In the interest of time, I'll not go into it. Now, why we do this plus minus also, I told you in the class. Okay, now I'll not go into it. Just now, for the interest of time, we'll keep it as plus minus. So if you have any increase in current assets, we reduce it. Decrease in current assets means plus. Increase in current liability means plus. Decrease in current liability means minus. They will give you various components of current assets and current liability. Compare and accordingly find out the plus. So here increase, decrease means what, sir? Sir, compare opening balance with closing balance and see whether there is an increase or whether there is a decrease and accordingly give this particular treatment. Okay. If you don't know the equation, easy to assume this. At least take this. Okay. Or take this. Okay. Decrease in current assets. If you don't know, I think I told you the logic with numbers and all. Now at least one trick, easy trick to remember this. Decrease in current assets. Let's say debtors. Okay. Debtors ka opening balance was 1 lakh. Closing balance has become 80,000. That means what? Debtor ka balance is reduced, right? From 1 lakh it has become 80,000 means indirectly we are doing cash flow statement. So analyze from that perspective. Don't say bad debts. Okay. We're doing cash flow statement. So from 1 lakh it has become 80,000 means 20,000 cash we have received from debtors. Okay. So debtors, so that's the reason debtors is part of current assets. Here debtors has reduced means the assumption is we have received cash from debtors. Hence a decrease in current assets we plus. Because if you receive cash means here in cash flow statement, if there is an inflow, we show it as positive, outflow, we show it as negative. So it's an inflow. Actually, this is not the reason. I told you the reason, but this way you can remember. Okay, now I'll not go into the actual reason because another 10-15 minutes will go there, which may not be relevant for us in the examination time now. Okay, fine. So when you remember, automatically you can construct the other ones. Suppose by chance, this is rare, instead of current assets and current liability, if they give you working capital directly, sometimes they'll say increase in working capital 10,000. Like that, if they give you what to do. So how do you get working capital? Current assets minus current liability. So if working capital is increased means indirectly they're saying current asset is more than current liability. Basically current asset is increased. Increase in current assets, what do you do? Minus. So that means this is directly related with increase in current assets. Well, it could be another reason also, but for now I think we can keep it at this. Yeah. So increase in working capital means that's possible when current asset is increased. So increase in current assets we do it as minus. Hence increase in working capital we show it as minus. If there is decrease in working capital we do the ulta, which is plus. Okay. All right. Doing all this, then you reduce the tax. Whatever tax paid amount you reduce, the final number what you're going to get is, after doing all those adjustments, the final number what you're going to get is the operating cash flow. Done. Okay, so only to find out operating cash flow, we have direct and indirect method. For investing activity and financing activity, we don't have any methods. Okay, that's the same. All right. Next, some more point is, sir, if you are building any property to be let out. So one building you are constructing with an intention to let it out. So that means this is an investment property. You are not purchased the investment property. You are constructing it with an intention to let it out. So during construction phase, if you're constructing, means you'll incur some construction cost, which will be an outflow. After construction, you will let it out and you will receive rental income. So that's an inflow. So if you are building any property with an intention to let out, the construction cost, which is an outflow, as well as the rental income, which will be an inflow later, both will be shown under operating activity itself, because that's part of your business, no? So hence both will be considered. Both is outflow, which is your construction cost, and inflow, that is your rental income received later. Both you will show it under operating cash flow itself. Then is, so how should we report this cash flow? On a gross basis or net basis? Sir, ideally recommended as gross basis. Certain entities can go for net basis. What does gross basis mean? Sir, suppose I have a land. I purchased the land for 15 lakh. One more land I have sold it for 35 lakh. Can I net off these two? No. You have to show this separately. That approach we call it as gross approach, showing the components separately. However, for pure organization like banking, financial institutions, brokers and all, the volume of transaction will be too high. So if you go for gross approach, the cash flow statement can become really big. So for them, the net approach is allowed, meaning the set off portion for them is allowed. For other entities, usually the gross approach is what is the IND AS 7 recommends. Okay. Then is the interest and dividend. Interest and dividend, you need to be careful. First, you need to check if the moment you see interest and dividend adjustment, dividend could be paid or dividend could be received. You need to first check whether it is a normal entity or a financial institutions. Is it a bank or a financial institutions, or is it a other companies? Because the treatment is different. Sir, if it is interest paid, now think, sir, if it's a bank, a main operation is what? Accepting deposits, giving out loan, and surplus money they will invest. So these three are main part of the operation. Accepting deposit, giving out loan, as well as investing. So these three are main part. If they have accepted deposit, they have to pay interest. This is part of their operation. So interest paid for financial institutions is not a financing activity. It is operating activity only, because part and parcel of their business. Similarly, interest or dividend received. They receive interest or dividend on their investments. Making investment also is part of their investments, because if they have too much deposit, they receive 100 crore deposits. If they lent out only 70 crore loan, that means 30 crores they will invest. And investment is a big part of bank, financial institution and banking a process. So interest and dividend received also is part of their operation. So you will show it as operating activity itself. All right. However, dividend paid. Dividend will be paid on their equity shares or preference shares. That they are a source of finance. So dividend paid is still a financing activity. That there's no change. Okay. This is for banker. However, if it's a normal entity, not a bank or a financial institution, a normal entity like Arivu Pro. So if we have paid interest, we will pay the interest on what? On debenture issued or loan taken. These are all financing activity. So interest paid also will be financing activity. Interest or dividend received. So our main business is not to invest. Our main business is to give coaching, right? If we have surplus income, maybe we may invest at some point of time. Regularly, we may not invest. So that means this is not part of our main operation. Interest received or dividend received will be received on investment. Because we have made the investment, we are receiving interest or dividend. So this will be treated as investing activity. However, dividend paid. Dividend will be paid on the equity shares. The equity shares or preference shares is a source of finance. So dividend paid will still be a financing activity itself. Tax I already told. Yes. So this was your quick conceptual revision relating to IND AS 7. So let's go over some questions. An entity has a bank balance in foreign currency aggregating to US dollars. Okay, they have money, not in Indian bank, but in foreign bank. And they have made money of US dollars, 100 rupees, equivalent to 4,500 at the beginning of the year. If you convert it into Indian rupees, it comes to 4,500 rupees. Okay. Presuming no other transaction taking place, entity reported a profit before tax of 100 rupees on account of exchange gain. They're saying no other transaction happened, only one transaction. This is only for the sake of exam they're giving. Okay. All right. Only one exchange gain we have received of 100 rupees because you have a foreign currency cash. No? You can't show $100 in your books. You have to convert it into Indian rupees. Okay. You have converted and this is a monetary item. Cash is a monetary item, right? So monetary item, but you have a foreign currency, cash in the form of foreign currency. So you have to convert it. Since it's a monetary item, you would have converted at closing rate. And when you convert into closing rate, you may get an exchange loss or an exchange gain. Here it's a case of an exchange gain. And how much is that? 100 rupees. That exchange gain is an income that you have transferred to P&L account. So they're saying this is the only income that is there in the current year. That's what is the assumption the question is asking us to make. Okay. What would be the closing cash and cash equivalents as per the balance sheet, not cash flow statement? So we'll do it both for cash flow statement as well as for balance sheet. We will take it. Sir, if you want to find out cash flow statement, they have not given any other data. So they've given profit car data. So that means we'll use indirect method. So we will use profit before tax. How much is the profit before tax that they told in the problems? 100 rupees. Okay. Alright. Then if you have any bookish adjustment, you need to do. Now this exchange gain of 100 rupees. You got 100 rupees profit because there's an exchange gain. This exchange gain, did you really receive in the form of cash, or it's just a bookish gain? It's a bookish gain that you have accounted due to forex fluctuation. You've really not received it as such. So yes, there's not 100 rupees is not your cash inflow. But due to this gain, your P&L has increased. If your P&L has increased, means indirectly your operating cash flow also has increased. But you have not got this gain. This is a bookish gain. Hence, what you have to do? Reduce this. So for cash flow statement perspective, first adjustment is unrealized exchange gain. This is unrealized. Only when you sell this dollars, then only it become realized. You have not yet sold. So there's an unrealized gain, so reduce it. So any other adjustment is there? No. That means your operating cash flow will be 0. Investing cash flow 0. Financing activity 0. No other data. Yes. Opening cash balance. If you add all of this, you're going to get increase or decrease in cash and cash equivalents. These are operating, investing cash. If you add operating cash flow, investing cash flow and financing cash flow put together, that we call it as net increase or decrease in cash and cash equivalents, which is also 0 here. To this, you add opening balance of cash and compulsorily you should get the closing balance. So what is the opening balance of cash? They only told 4,500. Take 4,500 and the closing balance as per cash flow statement. Closing cash and cash equivalents will be 4,500. This is as per cash flow statement. Correct. Only one bookish gain was there, which was accounted in profit, which we eliminated. Rest everything was 0. We updated 0. Opening cash was 4,500 given in the problem. So cash flow did not increase by any amount in the current year. So we got only 0 cash flow from all the activities. So hence cash flow at the end of the year also will be 4,500. This they did not ask. They asked how much is the cash flow as per how much is the cash and cash equivalent as per balance sheet. Now the drama is as per cash flow statement, the closing balance is 4,500. Same 4,500 you can't show it in balance sheet. Why? Sir, here it's a foreign cash. Foreign cash is a monetary item, and monetary item should be reflected at closing rate. At the year beginning, the value was 4,500. Now you got exchange gain. No, that means when you restated it at closing rate, the value is not 4,500, rather it is 4,600. Because you got an exchange gain means the value has to increase. No? Correct. So that means the cash value at the end of the year is 4,600, and 4,600 will come in your balance sheet. Yeah, cash flow statement here will. Cash flow statement ka cash balance and balance sheet ka cash balance will not match over here. Okay, so yes, that is because of these reasons. You can't help it. That's the way it will be over here. If you want, you can prepare reconciliation statement. You'll give a reconciliation like this, saying it is differing only because of this particular 100 rupees ka exchange gain, which you have to show it in balance sheet as per IND AS 21 ka provision, but you can't show it in cash flow statement because IND AS 7 says it's an unrealized gain. So there is a tug of war. So that's the reason that difference will be there. So you just give a reconciliation and leave it at that. This one question is a little popular from this. Okay. Another one is the actual preparation of cash flow statement. Okay. So if you have prepared this cash flow statement well in intermediate, you don't need my help one bit at all, because cash flow statement is the easiest. Every data is there in the question only. You just have to take it and accordingly, whatever some ledgers information will be missing, prepare ledgers for them and cash flow statement is over. Okay. But if at all you have not prepared cash flow statement in CA intermediate, then take a call. It's easy, you do it, but take a call how much time you have. Okay, if you don't have time, if you're watching this video on the examination day and all, then don't bother about it. Prepare on these sort of questions and little bit you do it, because it will take some time. Thank you so much for your comments. I'm in Bangalore only. I'm not teaching for CA Foundation anymore. I stopped it. Yeah, it's been almost like a year and a half or two, more than 2 years. Yeah, no time. Yeah. Definitely, I'll see you at CA Intermediate. Yes, CA Intermediate and CA Final. I'm continuing. So, yeah, if you come there and if you join us, definitely happy to have you on board. All right, but still, thank you for your wonderful comments. So, I'll move on. Following is a balance sheet of Kubera. That guy, rich person. That rich guy balance sheet they have given as on 31st March 20X2, and all the numbers are in lakhs. So, X2, X1. So, first they've given current year ka data and next they've given previous year ka data. So, watch out. Sometimes they interchange these columns. So, first they've given current year, then previous year. So some data they've given deferred tax asset, that is one catching my eye. Previous year it was 750, now this year it has become 855. Deferred tax asset has increased. So deferred tax asset is also an increase asset. How do you increase that? By debiting it. So you have to pass the journal entry DTA account debit. Okay, to what, sir? You can credit either OCI if it's OCI related DTA, or you will credit SPL or deferred tax expense if it is SPL related DTA. So we'll have to take a call. We'll probably read the adjustment and figure it out whether it is related to OCI or SPL. If they don't say anything, we'll always assume that it is an SPL related DTL. So in this case, they've not given any information. So in the interest of time, I'm telling you. So you'll pass the journal entry DTA account debit to SPL account. How much has it increased? 750 to 855. So the increase amount is 105. Okay. So how is this affecting cash flow statement? Think. So you have credited SPL due to this entry. If you have credited SPL means P&L balance will increase. If P&L balance increases means under indirect method from P&L only you are getting operating cash flow. So if P&L balance has increased means operating cash flow balance also has increased. But this deferred tax asset, is it really a cash item or it's a timing difference asset? Accounting books and tax books is not matching. To plug it, we are booking DTA. So all these are bookish assets. But because of this, your P&L increased, so your operating cash also has increased. So what do you have to do? You have to reduce. In your cash flow statement, 105 has to be reduced. That they must have given somewhere here. Check. This is your operating cash flow. Increase in deferred tax asset, they were reduced. That's one treatment you need to call out in cash flow statement. Okay. All right. Then other non-current assets and all, let's go to the information. This let it be. I'll come to that a little later. First, we will go into the adjustments directly. They've given profit after tax. They've not given before tax. Ideally, we need profit before tax, but they give profit after tax. So this is our starting point. Okay. All right. Next, sir. Check. Have they given any? All right. I think they have not given. We'll see it later. Okay. Let it be. So 4450 is the starting point. As and when we read the data, we'll go on punching the numbers. Interim dividend has been paid 450 lakhs. Sir, we have taken profit after tax. We have not taken retained earnings. So interim dividend affect retained earnings. I have not taken retained earnings. If I had taken retained earnings, due to interim dividend, retained earnings balance would have reduced. Hence, I had to add back. I did not take retained earnings. I have taken profit before tax. So dividend and all is not yet deducted. So I don't have to worry interim dividend adjustment in operating cash flow because I've taken profit after tax. That's the reason. All right. But you have paid the interim dividend. No. So dividend paid is a financing activity. So 450 lakhs should be reduced from financing activity. Check, have they done that? Where is this financing activity? Dividend paid 450. If it's an inflow plus outflow minus. So done that. Next, depreciation and amortized charge. Normally for PP and all, no sir, there will be some movements. So check here, previous year it was 12,500, current year it has become 13,000. There will be some movements here, some asset we would have sold and all that. Hence always better to do a ledger for them. So PP, let's do a ledger. So I've done it over here. Opening balance of PP is 12,500. Closing balance given it to be 13,000. From the balance sheet, I'm copying opening and closing balance because this is previous year ka closing balance, which becomes current year ka opening. This is your current year ka closing balance because all this data they're saying is relating to year end. So last year ka closing will become current year ka opening. So I've captured that. Opening and closing balance I've captured. Then next, what data they gave? Depreciation and amortization they've given. In the SPL has been charged in the current year as follows. PP ka depreciation is 500 lakh. What is the journal entry for depre? Depre to PP. So in the PP ka ledger, you'll post it as depreciation 500 that we have captured. Same thing I've done for intangible asset also. Intangible assets ka there is a movement. 30 became 50. So it's possible that some asset could have purchased it. So I'm preparing a ledger. Opening balance 30, closing balance 50 captured here. Okay. How much is amortization for depreciation or intangible asset? They told 20. The journal entry is amortization account debit to intangible asset. So you'll write by amortization 20 here. So these are all captured. Yeah. Next, what, sir? Okay. Next, during the year, we'll go one by one. Adjustment. During the current year, 2 machineries have been sold for 70 lakh. What's the journal entry for sale of machinery? Bank to machinery. So in your bank machinery ledger, you'll post it as buy bank 70. Okay, done. But the carrying amount of this asset was only 60. 60 worth of asset you have sold for 70. That means you made some profit. So the journal entry is investment account. You have credited investment by 70, but the carrying amount of investment was only 60. Okay, so in fact, you pass the journal entry as bank account. Usually that's what study material does. Usually the journal entry should have been bank account debit to PP account debit 60 to profit on sale 10. This is one way to pass the entry. Okay, profit should go to P&L. Or normally, usually in these sort of problems, how they study material interprets and pass the entries is they will write bank account debit. Okay, 70. All right, to PP account credit 70. The moment you sell the asset, they'll write bank to PP 70. This is the first entry. Okay. Then, but PP ka carrying amount was only 60, no? But you reduce by 70. You reduce by extra 10. So next entry they will pass is PP account debit how much? 10 to profit on sale 10. This is the entry which usually is done in cash flow statement. So that's what I've passed it in my ledger as well. So you'll write bank to PP 70. Then the posting of this entry is PP account debit to profit on sale 10. Done. Okay. This is one. First, let me capture everything, and then it's entire ledger cash flow impact. We'll push it in one go. This is one. Next, what's there? Anything else they told on machinery? No, nothing about machinery they told. So opening balance we ticked, closing balance we ticked. So this and all we have ticked. So if you just check, fixed asset ledger is not matching. There is a balancing figure on debit side for 1060. That means what? Some additional machinery we have purchased. That information, all this will be hidden. So you need to prepare the ledger and get that as a balancing figure. Okay. So this is arrived as a balancing figure. Now this impact we need to push it in cash flow statement. First look at the debit side. We'll push everything. Profit on sale. Profit on sale, sir, has been transferred to P&L already. So due to profit on sale, P&L balance is increased. P&L balance is increased means operating cash balance is also increased. But sale of PP is not an operating activity, but rather it's an investing activity. But operating cash flow has increased. Hence what to do? Reduce 10. Have they reduced 10 check? Yeah, here. Where? Here. Gain on sale of machinery, they have reduced 10. This is one impact. Next. This is machinery purchased. And there is also machinery sold. So both are investing activity. So 1060 and 70. Have they shown under investing activity? 1060 and 70. Sale of machinery and purchase of machinery shown. Okay, next is depreciation. So depreciation is a non-cash expenditure, but it has reduced your profit. So it has reduced your operating cash flow also. Hence, since it's non-cash, what we have to do? Add back. 50, add back, you need to do depreciation. Amortization is also there. 20, I think they've clubbed both and passed. This is your 520. Okay. So this impact fully we have pushed. Same goes for intangible asset also. Opening and closing that given. Amortization they have given. In intangible asset ledger is not matching. You're getting a balancing figure of 40, which is nothing but additional intangible asset purchased arrived as balancing figure. Intangible asset purchased is an investing activity. So under investing activity, 40 should be shown as negative, which they have shown. Okay. So these two ledger fully we have pushed. Okay. Next is what? Income tax paid. Sir, you don't pay the provision right away. First you make the provision, then you pay. So they have not given any provision. I don't see any provision for taxation data separately here. So the assumption is what? How much ever tax you paid, no? That much only provision you have made is the assumption. Sometimes they will give you provision for tax separately. In this problem, it is not there. So tax paid and tax provision for tax, I'm assuming it to be same. Okay. Why am I taking this? But in the problem, they told profit after tax. No, first they gave. We need profit before tax. Since whatever provision for tax you make, you have to add back. So hence we have to add back 105. This is actually tax paid. We are assuming that the tax paid and provision for tax is same. So you add back provision for tax of 105. All right. Why, sir? Sir, initially you add back for tax. There is a separate category at the end. Same under operating cash flow only. At the end, there is a separate tax paid wala category. You have to show it there. That's the reason we take profit before tax at the starting point. Tax paid, there is a separate cash format. There's a cash flow statement is dictated by IND AS 7. No? There's a format for tax paid. End there is a separate category. You have to show it there, which is shown. All right. Next is what, sir? Other non-current assets and current assets liability are related to operations of Kuber. Okay, they're saying it's part of operating activity. So nothing is part of investing or financing activity. So other non-current assets or current liability, if you see, everything is part of operation means it should come under working capital changes now. Okay, now one by one we'll consider working capital changes. So this is done. This is fully for other financial assets. Compare. Previous year it was 170. Current year it became 45. So it has reduced by 25. Decrease in current asset means plus. So I've added 25 check. Under working capital changes, decrease in financial assets 25 they've added. Okay, decrease in current assets means plus. Like that, one by one you need to compare. Deferred tax asset already we have adjusted, so it's fine. Other non-current assets also they told. Normally other non-current assets could be anything. But in this problem they're asking us to assume that it is part of operation. Hence we have to show it under working capital changes itself. 770 became 800. So it has increased. Increase in current asset means minus. So minus 30 they've done. Next, investment. So they have not told where is it? Here. Financial asset investment. Last year 2500, current year 2300. No adjustment. So means we have sold investment. This they did not say is part of operation. Investment sold comes under investing activity only. 2500 became 2300. So we have sold investment worth 200, which will come under investing activity 200. Considered a sale of, where is that? Sale of investment 200 considered. Okay. Next what, sir? Cash and cash equivalents 460. I told you always be aware of overdraft also, because cash and cash equivalents, this is opening cash and cash equivalents, this is closing. But before that, is there any overdraft? You need to reduce it. Is there any overdraft? Yeah, 60. So you'll not show opening cash and cash equivalent as 460. From this, you will reduce opening balance of overdraft. So 460 minus 60 you will do, which is what? 400. You will take it as opening cash and cash equivalents. That's what they've done. Similarly, closing balance of cash and cash equivalents is 220, but there is overdraft also, 75 reduce. So 220 minus 75 is how much? 145. That is the closing balance. Great. Next, what? Other current assets. 85 has become 195. So it has increased by 110. So increase in current assets means minus, which they have deducted. Next, share capital, no change. Great. Other equity we don't want. We want profit before tax, which we have got. Long-term borrowings. 5,000 has become 2,000. So long-term borrowings means your loan. 5,000 has become 2,000 means you have repaid. Repayment of loan is a financing activity. 3,000 you have repaid. So financing activity may 3,000 have they taken negative? Yes. Okay. Other non-current liability. Other non-current liability they asked us to assume in the problem to be forming part of operation. So it should come under working capital changes. 3615 has become 2740. So the difference is 3615 minus 2740. So other non-current liability has reduced by 875. Reduction means negative. So have they reduced 875 under working capital changes? Yes. Okay, next what? Come to financial liability. Trade payable from 90 has become 150. So increase by 60. Increase in current liability means plus. So I have added 60. Yes. Next, overdraft already captured. Other current liability 200 has become 300. So it has increased. Increase in current liability of 100 means plus. Plus 100 have they done? Yes. So all this they have done. This is your total. This is your total. So basically our cash flow from operating activity is 4025. All this is again total. This is again total. So cash flow statement matched out. So nothing else. 1 or 2 ledgers you need to prepare. Rest of the information will be given in question. If you prepare that, cash flow statement will be done. Question is there also there. Answer is also there only. Okay. So cash flow statement is quite easy. Okay. The next one, another kind of question that could come from this topic I feel is still now we prepared individual cash flow statement. Consolidated cash flow statement also is necessary. No? If it's consolidated financial statement, you may have to prepare consolidated cash flow statement. We're talking about that. So A Limited acquired a subsidiary entity. One entity A has acquired one subsidiary called entity B during the current year. Summarized information they've given. They've given consolidated SPL and also they've given balance sheet together with supplementary information. Okay. Consolidated SPL may they have given. Why have they given this? Because under indirect method, profit is our starting point. Now we want profit before tax. Do we know that? Yeah, profit before tax 70,000. This is a starting point. So we'll start off with this. So 70,000 have they started on? Yeah, they've started with 70,000. Great. So check in P&L what and all is deducted, sir. I don't have to refer the statement again. Interest cost they've already reduced. Sir, interest cost and all is what, sir? It's a financing activity, no? Okay, but they've already reduced it from the profit. So because if they have reduced from profit means P&L balance is reduced. So operating cash flow is also reduced. So what we have to do? Add back. Check have they added back interest of 4,000? Yeah. And interest paid is what activity? Financing activity. So same 4,000. Actually, this is not interest paid. This is interest cost. If they don't give any information, we assume that the interest cost and interest paid is same. Because we know that interest charges and all, we book it as per IND AS under effective interest method. And interest paid could be different. So if no other information is there, we assume that the interest cost and interest paid is the same. So here no other information is given. So under financing activity also 4,000 they've reduced it. There's an assumption. That's what you need to do if they don't say anything else. Okay, next this is done. They've reduced depreciation. Depreciation is non-cash. Hence what we need to do? Add back. Check have they added back depreciation of 30,000? Yes. So from this we have got necessary information. Let's move on to the next one. So if you just check, this is a consolidated balance sheet. Okay. So here you need to be really careful. Sir, you did subsidiary acquisition. You acquired subsidiary in the current year. All the shares here they've given. All the shares of subsidiary company were acquired for 74,000 in cash. The fair value of assets acquired and liabilities assumed were as follows. If you get a control over subsidiary company, subsidiary all assets and liabilities you need to show. So all the subsidiary ka fair value, because you obviously as per IND AS 103, you have to take over subsidiary ka net assets at fair value. So fair value of each assets they've given one by one. That is one. All right. Now, but the problem is here is directly, sir, you did subsidiary acquisition in the current year. So what has happened here is in the balance sheet, now current year data that you see includes subsidiary ka data as well. So 20x2 ka data here, this current year, it includes subsidiary ka data as well. But you did not have the subsidiary in the last year. So 20x1 ka data excludes subsidiary. 20x2 is current year. It includes subsidiary ka net assets. But 20x1 is last year. It excludes subsidiary. So under cash flow statement, what do we do for working capital changes? We compare. Opening balance and closing balance we compare and accordingly find out increase, decrease. But this is what, sir? Parent plus subsidiary. That is only subsidiary. That is only parent in fact. So straight away if you compare, that will be wrong. So first, whatever data is there included of subsidiary company, you eliminate. From this, you eliminate subsidiary ka data. That means you will only get what? Parent ka data. Now you compare and figure out whether it increased or decreased, like that. Okay, that's how you need to prepare it over here. Okay, that's the only change over here. Okay, we'll do it one by one. Cash equivalents, opening cash, closing cash. Check has a subsidiary. Oh, one more thing is, sir, now you think logically, how much did you pay to buy this investment? 74,000. You paid 74,000 in cash to buy subsidiary to get control over subsidiary. Subsidiary company already has a cash of 2,000 rupees. Now you think, sir, once you get control, all subsidiary assets is yours. Okay, 74,000 you paid in cash, and subsidiary already has a cash of 2,000. Correct? No, that means what? So you paid 74,000 cash to them, and the 2,000 cash will come back to you only now, because all subsidiary assets now belongs to you. So whenever subsidiary has a cash, you will not show investment purchased in subsidiary company as an investment. So this has to come under investing activity. Under investing activity, you will not show 74. How much ever cash subsidiary company has, you will reduce it, because in reality you only paid 72. Because though you paid 74, 2,000 cash has come back to you. So the real investment is only 72. So this subsidiary ka cash will be adjusted with investment and then show what's under investing activity. They'll only show 72,000 rupees. This is what is paid, and this is subsidiary ka cash. This will be netted off and will be shown under investing activity. That is one you need to remember in these sort of problems. Okay. Now the usual opening cash balance is what? All subsidiary ka data we have excluded down because we have considered separately. This is 5, this is 8. So opening cash balance is 5, closing is 8 that we have given. Now do the comparisons one by one. Trade receivables. Trade receivables ka, this is last year, no? Last year ka closing balance becomes current year ka opening balance. So opening balance is 50, closing balance is 54. Straight away don't compare. Sir, this 54 has subsidiary ka assets as well included. First exclude that. How much is trade receivable or subsidiary? They told 8,000. So reduce that. 54,000 minus 8,000 is how much? 54 minus 8 is 46,000. That means belonging to the parent is only 46. Last year also its parent ka data. Receivable of only parent was 50. So last year it was 50. Now it has become 46. So in fact it has not increased. It has reduced. 50 has become 46. Okay. First exclude subsidiary ka data and then do the comparison. Okay, so 50 has become 46. So it is decrease in current assets or data to the extent of 4,000. Decrease in current assets means add. Have they added a decrease in trade receivables? 4,000. That's what they prepared note there for. Okay, same thing we'll have to do it for the other assets as well. Opening balance is 35. Closing balance is 30. But closing balance includes subsidiary ka data. So reduce subsidiary ka. How much is subsidiary ka inventory? 4,000 here given. So reduce 4,000. So that means this is 26,000. Opening was 35. Closing is 26. So it is reduced by 9,000. So decrease in inventory means plus 9,000 have they added up? Yes. Okay. Then PP. PP usually we'll have to prepare a ledger, or we'll see. We'll just directly compare. How much is PP of subsidiary company? 110. This is already included. So directly check, sir. 160 includes 110. That means the parent ka PP is only 50,000. It was how much last year? 80,000. Now it has become 50,000. So it has reduced means sale, sir. No, hang on. There is depreciation also, no? How much is the depreciation? 30,000. Oh, okay. That means no change, no? Sir, you had opening balance was 80,000. You deducted depreciation. You deducted depreciation of 30,000. If you deduct a depreciation of 30,000, how much will you get? 50,000. And how much are you getting now? 50,000. That means there is no PP purchase nor PP sold over here. Once you eliminate subsidiary ka data and reduce depreciation from 80, it's matching out. 80 minus 30 is 50. Closing balance is also 50. Opening, and it's matching out there. So basically no PP, additional PP has been purchased, or for that matter sold. Goodwill. 0 has become 18. Goodwill is is it really a cash flow item? Did cash come in or cash go out? No. So you can ignore that. So that doesn't have a place here. Trade payable. 60 has become 68, but straight away you can't compare with 68. 68, this 68,000 closing balance includes subsidiary ka data. How much subsidiary ka trade payable is included? Subsidiary ka is 32,000. So 62,000 minus 32 euros. 68 minus 32 is, you get 36. Okay. Opening was 60, closing has become 36. So 60 minus 36 is what? 24. So trade payable is reduced. Decrease in trade payable 24,000 means you need to minus. Have they minus 24,000 deducted? Yes. Next is what, sir? Income tax payable. They've given income tax payable and they've also given tax here. This tax stands for provision for tax. Okay. Then they have given income tax payable. Whenever they give you provision for tax in P&L and income tax payable, prepare a ledger for them. It's better. I think I've already done it here somewhere. A provision for tax. How much is the opening balance? You don't have any tax for subsidiary company here. Okay. All right. Fine. So every tax cut data is relating to parent only. How much? Opening balance is 11, closing balance is 12. So capture that. Opening balance 11, closing balance 12. And in P&L, there was already provision for tax. How much provision for tax is there? 15,000. What is the journal entry for provision for tax? SPL account debit to provision for tax, right? So in by provision for tax account, you'll post it as by P&L. This is given in the problem. Okay. So these three data was given. Ledger is not matching. You're getting a balancing figure, which is 14,000. That is nothing but tax paid. In this problem, tax paid information was not given. So provision for tax in P&L was given and opening closing balance was given. So using this, you will be able to get tax paid in the current year, 14,000. This we have already added back. I think we did not consider. We directly took profit before tax, so adding was not required. But tax paid, we need to deduct it as a separate category. In operating cash flow only, tax paid should be deducted, which is here. They have directly done. If you want, you can show like this also or prepare a ledger, your call. Okay. That is one. Next is what, sir? Long-term debt. 64 has become 1 lakh. But first check, do we have subsidiary has any long-term debt? Yeah, it has 36. So first eliminate this. 1 lakh minus 36 you do. From 1 lakh, if you deduct 36, you're going to get 64. Opening balance was also 64. Closing is also 64. So have you repaid any debt? No. Have you taken any debt? No. So no movements, we ignore. So rest everything is the total. So yeah, this also we have acquired. So rest, I think everything, if you just check everything we have ticked. So this is a total. Okay. So cash flow statement is done for. That's all this is all about. Okay. There's another problem where they give you subsidiary data as well. First, you need to exclude it and then compare and accordingly find out how much working capital or how much current assets and current liability have increased or decreased. This question came in a mock paper for about 10 marks. I think it's come in one of the previous year attempt also, I think. All right. So one more question we will run through. This is about classification. How will you classify the components in cash flow statement? It's given question. I think we'll take it here only in this because this is the thing. So all these are components. You need to tell whether they're operating, investing or finance. Okay, you need to give the classification based on banks. If it's a bank or financial institution, what will be the classification? If it's other entities, what will be the classification? Maybe first we'll do it for banks. Okay, all right, or maybe we can do it together also. Interest received on loans and advances given. For a bank, loans and advance given is part of operation. So that means this will be operating activity. But for another entity, interest received on loan is, they've given a loan. So loan given for another entity is an investment, right? It's not part of their operation. It's not routine. I mean, or maybe first we'll do it off a bank. It's easy. Yeah. Interest paid on deposits. For bank, deposit and all is part of operations, so operating activity. Interest and dividend received. Normally, if that stopped there, interest and dividend received. For banking or financial institutions, we would have done operating activity. But they told here, this is interest and dividends for investment made in subsidiary. Sorry, investment made in subsidiary. Every bank will go on purchasing in shares of they'll go on purchasing subsidiary ka shares. No. That means investment made in subsidiary associate joint venture is not that routine. Investments you will buy, but not to that extent also. So investment made in subsidiary joint venture and all is an investing activity only. So any interest received on that is also investing activity. Okay. If they had not given these words, if they had just told interest and dividend received, we would have classified it as operating activity. But they told this interest dividend received is on investment relating to subsidiary. That is an investing activity. Dividend paid doesn't matter whether dividend on preference shares or whatever, it's a source of finance. So dividend paid is a financing activity. Finance charges paid by lessee under finance lease. Finance lease is a source of finance. Yeah. So it's a financing activity. Payment towards reduction of finance lease liability. That's also financing activity only. Interest paid to vendor for acquiring fixed assets under deferred payment terms. Deferred payment means you are getting a free source of finance. You're not making the payment now. You're delaying the payment. So it acts as a free source of finance. So the interest paid on this is like what? It's like you have taken a loan, on that you have paid interest. So this is the financing activity. However, principal payment under deferred payment for acquisition of fixed assets. So principal payment, if you observe, we always record in case of deferred payment terms, fixed assets and all, we used to record it at cash selling price, we used to say. Yes, no, excluding interest there. So you purchased, let's say you purchased fixed assets for 11 lakh rupees. In this 11 lakh, 1 lakh is towards interest and 10 lakh is towards principal. So, okay, there's 10 lakh towards this principal, PP. Okay. So totally you have paid 11 lakh rupees for the asset. You're showing an asset at, you have to record asset at cash price equivalent. No? That is 10 lakh and balance you are recording is interest. So you have to pay this, right? So when you pay this 10 lakh, PP purchased is investing activity. So this it will come under investing activity. This will come under financing activity. That's what they're saying over here. So interest portion here refers to 1 lakh. That you show under financing activity. But the principal paid is towards the PP. So that will be for PP purchase. PP purchased is your investing activity. So that you'll show under investing activity. Penal interest received from customer. Customer is our data runner, is part of our operations, so operating activity. Interest paid to our suppliers, creditors, part of our operations, operating activity. Income tax, interest paid on income tax, income tax refund. If they don't give any information about tax we always put it under operating activity itself. Okay, this for the banks. Same classification if you want to do it for other entity. Interest received on loans and advances given. Loan given is an investment. It's not part of a routine activity for normal entities. Yes. So loan given is part of an investment. So interest received on that will be an investing activity. Interest paid on deposits and other borrowings. Borrowing is a source of finance. On that, if they have paid interest, means it's a financing activity. Interest and dividend received on investment in subsidiary, investing activity. Dividend paid, financing activity. Finance charges on both of this, financing activity. Same. Interest paid to vendor for acquiring fixed assets and a deferral portion. Interest paid acts as a financing activity, but principal portion will be investing activity. Customer supplier payment, operating activity. Income tax, again, operating activity. Okay. Yeah, this is about one more about the classification. So with this cash flow statement question also we have completed. People, there are about couple of standards about I think IND AS 10, IND AS 2 and related party disclosure. Normally the way I do it is after once my regular class is over, I revise each chapter with the help of chat book. Full revision we do it as part of regular class only. Once the whole topic is over, I revise the whole topic with the help of a chart book. So I will post those 3 videos ka revision video I've already done during my regular class only, that I will attach to the marathon. I will post it. Okay. So IND AS 1 is nothing there. An analysis of financial statement is this only. Okay. In one more topic, analysis of financial statement, that is nothing but they would have done some mistakes in application of IND AS. So if you know IND AS concepts properly, analysis of financial statement is not really a separate topic. Okay. So I think with this we shall wind up. Okay. Take care. See you. Bye bye. Yeah.